Great to have you. You know, part of the challenge of covering the address usually is trying to decide what's worth talking about for the market, because a lot of it is not going to wind up being policy, especially when half of Congress is opposition controlled. What do you think is going to be truly important tonight?
Well, Carl, I think markets aren't going to be really focused on it, right? I mean, I do think, as you say, a lot of this has already been telegraphed. It's digested by the marketplace, and these aren't big macro changes that he's proposing here tonight. So I don't expect any real market reaction. Obviously, the big news for markets today would be Jay Powell's speech at the Economic Club of Washington later this afternoon. I think that's what they'll be focused on, not the State of the Union address.
Right. And certainly if we can tell from Bostic and Kashkari the last 24 hours, a lot of it's going to center around whether or not that print on non-farm payrolls was real. You don't buy it.
No, it's making a case, though, Carl. I mean, the job market obviously is very resilient. Businesses are really reluctant to lay off workers. They know that, once we get to the other side of the adjustment to the rate hikes and the high inflation, their big problem, their number one problem is just going to be holding on to finding workers, holding on to workers. They really don't want to lay off workers. And that's clear in the jobs data. That's clear in the unemployment insurance data. And by the way, that's a reason for some optimism that the economy can navigate through without a recession, because it's hard for me to see, a recession without significant layoff. That's critical to, getting people to pull back on their spending and pushing in. So I think it's all really good news. So, I think that it's making a case that the job market is strong, but it's overstating the case, right? I mean, if you look at other data, particularly data with regard to future revisions to what we're observing now, this is going to be revised down meaningfully. So I suspect the job market's still creating lots of jobs, probably too much for the Fed to like. They want to see job growth down below 100K a month. I don't think we're there yet, but I think we're headed in that direction. It's not 500K, but it's something south of, closer to 250. Not as far as we need more, but we're headed in the right direction.
Mm-hmm. I mean, just to pick up on that thread, Mark, you've had three officials. We were talking about this with Steve Leisman earlier this hour. We've had three Fed officials post that jobs report on Friday, basically come out and say either explicitly or implicitly that perhaps if this continues at this robust rate, the terminal rate needs to go higher. Your thoughts on that?
Oh, yeah. I mean, that's pretty clear, right? Morgan, I mean, 500K, that's a lot of jobs.
Yeah.
I think 100K is kind of the benchmark, a good bogey. Anything north of 100K over time, the unemployment rate is going to continue to decline. As you know, the unemployment rate's at a 50-year plus low, 3.4%. That can't be what they want. So they need to see job growth moderate more fully here. I do think, though, again, job growth is moderating. That'll become clearer as we get more data and we get those revisions. The other thing I'd point out with regard to the last month's jobs numbers, that was really juiced by weather, right? I mean, it was a very warm January. It felt like that a lot of things were all juiced up by weather and seasonal adjustment issues and measurement issues. So as we get more data and these measurement issues get ironed out, I think we'll have a clear signal that the job market is slowing to something that's more consistent with what they want. And we don't need to see a terminal rate that's much above 5%.